Stocks have begun the last trading session of the month slightly higher despite another round of heavy selling in the U.S. technology space the day before. Weakness in a key report on manufacturing sector conditions in China was also weighing on sentiment, although gains in government bonds in Japan and the U.S. in the wake of the Bank of Japan's decision to lower its inflation forecasts appeared were acting as a partial offset. To take note of, share prices sometimes derive a degree of support at month-end, helped by window dressing on the part of fund managers. Against that backdrop, the FTSE 100 was edging higher by 0.10% or 7.15 points to 7,707.93 as of 0900 BST. Commenting on Tuesday's early market action, Mike Van Dulken and Art Jamhatsadurjans at Accendo Markets said, calls for a muted open come after tech sector losses on Wall Street extended into a mixed Asian session, with Australia and Japan the lone gainers in the sea of red. The Bank of Japan's BOJ decision to allow more flexibility in its stimulus program kept the Nikkei positive. However, China PMIs missed expectations. Watch the miners, they were up in Australia, with manufacturing at its lowest since February, and non-manufacturing at its lowest since last August. To take note of, U.S. tech giant Apple was scheduled to update investors after the market close on Tuesday. As expected, rate setters in Japan did tweak the framework for their monetary policy, with central bank governor Haruhiko Kuroda saying the monetary authority will now allow benchmark 10-year Japanese government bond yields rise as high as 0.20% versus 0.10% previously. Policymakers also announced their decision to shift purchases of ETFs towards those of shares listed on the Topix index. Significantly, however, they also pledged to keep policy rates at extremely low levels for an extended period of time, and cut their medium-term projections for inflation. The response in Japanese 10-year bonds was immediate, with their yield retreating by 5 basis points to 0.05%, and that on similarly dated U.S. Treasuries off by another 4 points to 2.94%, retracing the prior day's gains. In China, meanwhile, the official Factory Sector Purchasing Managers Index for July printed at 51.2, which was down from a reading of 51.5 for the month before. A gauge of export orders included in the survey was steady, likely showing that weakness in the Chinese currency, the yuan, was compensating for the impact of U.S. tariffs, however, thus revealing that domestic headwinds were acting as the main drag on activity. On the geopolitical front, meanwhile, U.S. President Donald Trump appeared to open the door to meeting with Iranian leaders. Yet in parallel, reports surfaced that North Korea might be continuing to develop intercontinental ballistic missiles at its facility located in Sanam-dong, outside the capital Pyongyang. Cash flow drops at Centrica, dividend payout raise at BP. Centrica posted its interim results for the period ended the 30th of June on Tuesday, reporting stable adjusted gross margin and EBITDA relative to the first half of last year, with adjusted operating cash flow falling 11% to £1.1 billion. BP reported second quarter profit 4 times higher than a year earlier as the oil company increased its dividend for the first time in almost 4 years. Underlying replacement cost profit for the 3 months to the end of June surged to $2.8 billion, £2.1 billion, from $684 million the year before. BP increased its quarterly dividend 2.5% to 10.25 cents a share, the first rise since the third quarter of 2014. Standard Chartered's first-half profit rose by almost a quarter as revenue rose and bad debts halved at the emerging markets-focused bank. Underlying pre-tax profit for the 6 months to the end of June rose 23% to $2.4 billion, £1.8 billion, as operating income rose 6% to $7.6 billion. Credit impairment dropped to $293 million from $583 million a year earlier. Operating costs rose 7% to $5.1 billion as Standard Chartered invested in digital banking services and internal efficiency programs. Just Eat reported a slight slowing of revenue and order growth and a 3% fall in pre-tax profits for the first half of the year as the online food ordering website increased investment to keep the top line growing. The FTSE 100 Group kept its guidance for full-year underlying profits unchanged at £165 minus 185 meters but raised its revenue guidance to £740 minus 770 meters. Rentokil Initial posted a decent set of first-half results, with revenue and profit in excess of its medium-term financial targets. The pest control and hygiene firm said ongoing revenue was up 14.2% at constant exchange rates to £1.17 billion, while ongoing operating profit grew 13.1% to £134.5 million. The interim dividend was increased 15% to 1.311p per share. Fresnillo reported an 11.3% improvement in adjusted revenue to $1.19 billion for the 6 months ended the 30th of June. The FTSE 100 precious metals miner said gross profit and EBITDA were $502.2 million and $566.9 million, increases of up 9.2% and 8.5% respectively. Indivior's lawyers have achieved another victory in the drug developer's ongoing U.S. court battle, which will prevent rival Dr. Reddy's Laboratories from selling its generic version of Suboxone film. The U.S. Federal Court of Appeal has denied Dr. Reddy's motion to block a preliminary injunction that was granted at the request of Indivior to prohibit the generic drug maker from selling its buprenorphine naloxone sublingual film product.